Hello, this is Samantha Shares. This episode covers NCUA's new proposed rule on federal credit union loan interest rate ceiling voted on at the July 18th board meeting. The proposed rule passed by a vote of 3-0. The following is a word-for-word real audio of that item. This podcast is educational and is not legal advice. We are sponsored by Credit Union Exam Solutions Incorporated, whose team has over 240 years of national credit union administration experience. We assist our clients with NCUA so they save time and money. If you are worried about a recent, upcoming, or in-process NCUA examination, reach out to learn how they can assist at marktrickle.com. Also check out our other podcast called With Flying Colors, where we provide tips on how to achieve success with NCUA. And now the NCUA board.
The last item of business today is the Federal Credit Union loan interest rate ceiling. Nagi Khalid, Director, Credit Markets Division, Office of Examination Insurance, will deliver the staff presentation, and Amanda Parkhill, Deputy Director, Office of Examination Insurance, will join in. Actually, will remain at the table to answer any questions. Good morning, Nagi, and good morning, Amanda. Nagi, please start whenever you're ready.
Good morning, Chairman Harper, Vice Chairman Hoffman, and Board Member Otska. At the January 26, 2023 NCUA board meeting, the board voted to continue the temporary 18% interest rate ceiling for loans made by federal credit unions for a period of up to 18 months based on the authority established by the Federal Credit Union Act. That temporary period is set to expire on September 10, 2024. We are here today to brief the board on our staff recommendation for where to set the rate ceiling moving forward following the expiration of the current temporary interest rate ceiling. Next slide, please. In 1934, Congress established a 12% loan interest rate ceiling for loans made by federal credit unions. In March 1980, through the Monetary Control Act, Congress raised the interest rate ceiling to 15% and authorized the NCUA board to set a higher interest rate ceiling when certain conditions are met for a period of up to 18 months at a time. In December of 1980, the board raised the interest rate ceiling to 21%, and subsequently, the board lowered the rate ceiling to 18% in May of 1987. And since then, the board has voted 23 times to maintain the temporary 18% interest rate ceiling, and as previously mentioned, was most recently extended at the January 2023 board meeting through September 10th of 2024. Next slide, please. This slide represents the history of the loan interest rate ceiling since 1949 in comparison with the movement of the bank prime rate. The blue dash line is the Federal Credit Union loan interest rate ceiling, and the green smooth line is the bank prime loan rate. And since 1987, when the NCUA board first set the loan rate ceiling at 18%, the spreads between the Federal Credit Union loan interest rate ceiling and the bank prime rate have ranged from 650 to 1,475 basis points, with an average of 1,190 basis points. Currently, the spread is about 950 basis points. Next slide, please. The Federal Credit Union Act includes 3 requirements that must be satisfied for the board to raise the loan interest rate ceiling above 15% for periods not to exceed 18 months at a time. First, the board must consult with appropriate committees of Congress and a number of appropriate external agencies on the changes. The board must also determine that the money market interest rates have risen over the preceding 6 months. And finally, the board must determine that the prevailing interest rates threaten the safety and soundness of individual credit unions as evidenced by adverse trends in liquidity, capital, earnings, and growth. Next slide, please. As mentioned earlier, the Act requires the NCUA to send notifications to appropriate committees of Congress, the Department of Treasury, and the Federal Financial Institution Regulatory Agencies. The NCUA sent those consultation letters in April of 2024, and they included the Secretary of the Treasury, the Chairman of the FDIC and the FRB, the Comptroller of the Currency, and the chairs and ranking members of the Senate Committee on Banking, Housing, and Urban Affairs, and the House Committee on Financial Services. Next slide, please. The second requirement noted is that the board must determine that money market interest rates had risen over the preceding 6 months. And as shown on the table on this slide, the money market interest rates increased between October 31st of 2023 and April 30th of 2024, as evidenced by the changes over that period to both the average money market deposit rates and the 180-day average secured overnight financing rate. The changes vary from 13 to 21 basis points for those selected money market rates. Next slide, please. The Federal Credit Union Act also mandates that the board must determine that the prevailing interest rate levels threaten the safety and soundness of individual credit unions, as evidenced by adverse trends in liquidity, capital, earnings, and growth. NCUA staff conducted an assessment of the interest rate ceiling's impact on safety and soundness. And as of December 31st of 2023, there were 2,159 credit unions, or about 75 federal credit unions, or about 75% of the total population of federal credit unions that had issued loans with rates above 15%. And loan balances with rates above 15% totaled about $42.6 billion, and these loans carried an average loan rate of 17.31%. The table on this slide summarizes this information and shows the breakdown of these federal credit unions that have a low-income designation, a minority deposit insurance designation, or are certified as community development financial institutions. It also shows the federal credit unions that have a concentration rate of above 10% of total assets in loans with rates above 15%. Next slide, please. Given the prevailing interest rates, NCUA staff estimates that a reversion to the statutory loan interest rate ceiling would threaten the safety and soundness of as many as 1,139 federal credit unions, given the impact to one or more areas of performance in liquidity, capital, earnings, and growth, which are the four risk categories outlined in the Federal Credit Union Act. The table on this slide shows how many categories were triggered for the 1,139 federal credit unions meeting at least one of those risk criterion. And as of December 31st of 2023, $37 billion, or about 87% of loan balances with interest rates greater than 15%, were held by these 1,139 federal credit unions collectively, with an average interest rate of about 17.35% for those loans with rates above 15%. If the interest rate ceiling were to revert to 15%, a 235 basis point reduction in average loan interest rates could lead to as much as $873 million of lost future annual interest income for those federal credit unions. The adverse impact would be particularly pronounced for 273 federal credit unions that are already struggling with negative earnings, 37 federal credit unions with low net worth ratios, and 49 credit unions with greater than 10% of their assets and loans with rates greater than 50%. Next slide, please. Since 1987, when the NCUA board first set the loan interest rate ceiling at 18%, the spreads between the federal credit union loan interest rate ceiling and the prime rate have ranged from 6.50 percentage points and 14.75 percentage points. And currently, as noted in prior slides, the 9.5 percentage point spread between the current loan rate ceiling of 18% and the current prime rate is still sufficient to support loan pricing needs in federal credit unions. Overall, federal credit unions maintained sound performance during 2023 with the current 18% loan rate ceiling. NCUA staff assessed that in the current environment, an 18% loan interest rate ceiling provides federal credit unions with sufficient risk pricing ability to manage liquidity, capital, earnings, and growth, and protects member access to safe and affordable credit, and does not require federal credit unions to incur any additional operational burden or costs associated with a change to the loan rate ceiling. Next slide, please. In addition to the statutory considerations, NCUA staff also assessed the interest rate ceiling's impact on a program integral to a lot of members, which is the Payday Alternative Loans Program, or PALS. The PALS program provides federal credit unions with diversification in their loan portfolios, but more importantly, it provides a better alternative to payday lenders for tens of thousands of members who need it the most. The current interest rate ceiling on the PALS program is 28%, which is determined by adding 1,000 basis points to the interest rate ceiling when the NCUA sets a higher than 15% loan rate ceiling. However, if the federal credit union loan rate ceiling reverts back to the 15% statutory limit, the maximum allowable PALS rate would also fall back to 15%. Next slide. Same slide. Allowing the loan rate ceiling to revert to 15% would constrain a federal credit union's ability to apply risk-based pricing for borrowers who currently take advantage of the PALS program. And more importantly, reversion of the interest rate ceiling could lead to the elimination of PALS lending if federal credit unions can't price these loans appropriately for the risk. And this could result in tens of thousands of federal credit union members being driven to other, more expensive lenders to meet their borrowing needs. Next slide, please. In summary, staff recommends the NCUA board establish a temporary maximum loan interest rate ceiling of 18% for the 18-month period effective September 11th, 2024 to March 10th, 2026. Next slide, please. This concludes our presentation. Thank you for your time this morning, and we'll be happy to answer any questions you have.
Thank you, Nagi, for the work of you and your team on the reconsideration of the federal credit union loan interest rate ceiling. I appreciate all your efforts in bringing the interest rate ceiling for federal credit unions before the NCUA board today. And thank you, Amanda, for being here to answer any questions that we might have. As noted in the presentation, the NCUA board in January 2023 last authorized an 18% ceiling for the loan interest rate for federal credit unions effective through September 10, 2024. If the NCUA board does not act today, the maximum interest rate for federal credit unions that they may charge will revert to 15% on September 11th. Specifically, the Federal Credit Union Act requires that the rate of interest a federal credit union can charge may not exceed 15% annually. But in setting the statutory ceiling, Congress also incorporated a regular review process, or an escape hatch, if you will, for the NCUA board to reconsider the ceiling and adjust it under certain conditions after following certain procedures. Specifically, the board may, for a period not to exceed 18 months, determine to exceed the statutory 15% ceiling after completing the required consultations, reviewing the interest rate environment and market conditions, and completing certain assessments required by the law. Here, the NCUA team conducted a really thorough analysis of recent market and financial conditions and concluded that money market rates have risen over the preceding 6-month period. That fact should come as no surprise to anyone who has monitored our financial markets and the recent decisions of the Federal Reserve Board's Federal Open Market Committee. The NCUA team also completed its required consultation with Congress, the other federal banking agencies, and the Treasury Department. I also believe we received no comments back on that. Am I correct on that?
That's correct.
Good. Finally, the NCUA team determined whether the prevailing interest rate levels threaten the safety and soundness of individual credit unions with respect to liquidity, capital, earnings, and growth. That analysis concluded that lowering the interest rate ceiling below 18% would indeed be detrimental to a certain number of credit unions. I want to pause here because am I correct in assuming that most of those credit unions, it's because of their credit card portfolios? Home loans certainly aren't at 18% or anywhere near it. Home equity lines of credit aren't at that rate. Is this primarily a credit card issue?
Unsecured loans, primarily credit cards and other personal unsecured loans, correct.
That's helpful. To that end, the NCUA experts have recommended that the NCUA board vote to temporarily establish a maximum loan interest rate ceiling of 18% for the 18-month period effective September 11, 2024 through March 10, 2026. I agree with this recommendation and will vote for this item. Before closing, we must always remember who ultimately feels the effects of these interest rate ceiling decisions. The credit union system's statutory mission is to support the credit and savings needs of all Americans, especially those of modest means. And it's those American households that are under increasing financial stress from financial pressures the NCUA would place under additional stress if we were to raise the interest rate ceiling. And the NCUA should not cause unnecessary safety and soundness risks for federal credit unions by inappropriately lowering the rate. This balanced decision is the right one to protect the financial prospects of those who use the credit union system and ensure that the credit union system remains safe and sound. That concludes my remarks. I now hand it over to the Vice Chairman.
Thank you, sir. And thank you guys for the detailed analysis. So just review the history. 1980, that's the most important year in this entire discussion. 1980, they passed the Monetary Control Act, which raised it from 15 to 12, as the chairman said, the maximum rate we could charge. It had been 12% all through the 70s. And Congress also gave some discretion for certain reasons. The only number in the Federal Credit Union Act, the only interest rate is 15, right? 15, quince, jugo in Japanese. That's it. It's the only number in there. If you recall, why did this happen? Okay, and that's what drives our decision today. Because the Volcker Fed was raising rates to unprecedented levels. 1980, the prime rate hit 21. At the time, it was 20.5. Later that year, it hit 21.5. The Fed rate was a range of 19 to 20. Back then, they had a 1-point range. And so they understood that it was impossible to extend any credit. But, the Fed rates basically where banks borrow overnight. You're never going to borrow from a bank cheaper than the bank can borrow. That's why it set short-term rates. So immediately after the Monetary Control Act was passed in 1980, the board raised it to a maximum to 21%, where it remained for a few years. Okay, and this was done hand in hand with Congress, and both anybody that had a price cap back then was talking to Congress, and that resulted in this bill. So this is Congress's intent, the best we can tell. We know at a time where the prime rate at the time of passing it was 20.5, that the 21% that NCUA put it at was adequate and did not back and was supported by Congress. So 21% when the prime rate was 20.5 and the Fed was a range of 19 to 20. That's the context here. So as the chairman said, to raise the rate anytime above 15, consultation with Congress, money market rates have risen over the last 6 months, prevailing interest rates, and that prevailing interest rates threaten the safety and soundness of individual credit unions. If the board does not act today, the maximum rate reverts back to the maximum of 15. The last time we addressed the interest rate, the board requested an analysis from the General Counsel on whether a variable rate would be legal. Although it was determined to be legal, and I personally think economically it's the smartest one, let it move with markets, not with what the board decides to do. But for one thing, any variable rate that we could possibly enact would mean a maximum rate well below 15. I assure you the people arguing with us would not be quiet if we had a maximum rate on anything unsecured at 12%, let's say, okay? I don't believe at NCUA we could legally use a variable rate that was, say, the prime rate or even the Fed's overnight rate plus another 15, 16%, right? 16% plus the Fed's overnight rate today already puts you over the 21% that they did in 1980 when the prime rate was 20.5. It doesn't even make any sense. So to everyone who objects to our current rate cap, what we're voting for today, and I'm going to vote for it, this is a matter for Congress. Once someone reads the actual law that we at the NCUA will follow, they arrive at the same conclusion. It's a matter for Congress, not NCUA. We're only here to do what Congress tells us to do. We're not here to decide what interest rate cap is ideal. I say this because many of the people who've argued for higher rates are not aware of what NCUA is told to do. There's only two kinds of people. People who argue for things like prime plus 15 and people who've read the act. Almost every time I ask somebody, all right, well, if you were in our shoes, what would you do? What would your policy be? It's usually variable. Again, that's a smarter way to do it. I say, what would you implement? The answer I get is always one that's illegal. I'll mention that I'm aware of the negative effects of government price setting. I don't need to be told about that. I agree with it. I'm aware it's usually the least of these that get harmed when government interferes in market prices, that people are going to go to other lending sources or not have a credit card. It's hard to operate in America without a credit card. And I know you can't even issue one to some people, if given their risk profile, if the cap is 18. Currently, we do not have evidence, if you go back to 1980, that resembles that period. Okay? But, of course, there are signals that lowering it would threaten the safety and soundness of individual credit unions. The 18% ceiling provides low-income and CDFI credit unions some headroom above the statutory rate of 15, and of course that means 10% above that is our PALS loan. For some low-income community and CDFI credit unions, it could be most of their membership that would get walloped here. With that said, this is a question for you. If the rate were allowed to revert to 15%, can you discuss how many credit unions would be impacted from a safety and soundness perspective? And what portion would be low-income, MDI, or CDFI?
Certainly. So about 1,139 federal credit unions would be impacted from a safety and soundness perspective to any one or combination of the risk categories defined in the statute. And of those, about two-thirds, or about 759 federal credit unions, either have a low-income or MDI designation or are certified as CDFI institutions.
1,100 something. That's ballpark a quarter of the credit unions in America? Okay. And then the majority of those are low-income MDI or
Correct.
CFI, right? Okay. Just an interesting footnote, I think partly to some entrepreneurs out there, some technology has helped that the PALS loans, which were never feasible for lender or buyer in most cases, they've made some entrepreneurs, some private businesses have created technology to make it a little more feasible. So we've seen increase in outstanding PALs, both the number, 18-month period ending last December. Balance of PALs went from 84 million to 120 million. That's over 40%. The number of them went from 111,000 to 150,000. That's 35%. So that is an interesting note in all of this. That concludes my remarks. I have no further questions.
Thank you. Board Member Rotska.
Thank you, Chair Harper. And thank you, Nagi and Amanda, and thank you to all the staff who've been working on this. From 1987 until now, there have been economic downturns, including the Great Recession, high inflation, the pandemic. Yet the credit union system has been able to grow with an interest rate ceiling of 18%. My colleagues have kind of gone through some of the history on that. At the end of 1987, our system of cooperative credit totaled $160 billion in assets. Today, as of March 2024, our credit union system has $2.3 trillion in assets. This is evidence that credit unions can thrive while providing their members access to credit at these reasonable rates. Congress established specific statutory requirements that the board must consider before setting the rate ceiling above 15%. Staff's analysis and due diligence consistent with the statute supports keeping the interest rate ceiling at 18%. Only in 1980, when inflation peaked at 14.6%, far higher than it is today, did the NCUA board raise the interest rate ceiling to 21%. Today, at the same time, loan portfolio data from our call reports indicates that consumers are already feeling squeezed. So talking about the borrowers here, between quarter 1, 2023 and quarter 1, 2024, credit card balances grew by $6.6 billion or 9% to $80.8 billion. This is more concerning when coupled with the fact that credit card delinquency rate rose by 54 basis points during the last year. Furthermore, the delinquency rate for the other major loan products offered by credit unions, such as auto loans, residential real estate, are also increasing 21 and 19 basis points, respectively. So, Nagi or Amanda, do you anticipate that raising the interest rate ceiling to 21% could cause the delinquency rate across loan products to further increase? And I know in other board meetings and briefings we've talked about how you guys are watching delinquency rates.
So I can address that question, Board Member Scott. And I'll address it from a borrowing cost perspective. So with a higher interest rate ceiling, loans could become more expensive for borrowers and leading to potentially increased monthly payments. And those borrowers you mentioned are already financially stretched, may struggle to keep up with higher payments, which could potentially result in higher delinquency rates, particularly in a challenging economic environment where rising costs and inflation, especially if the unemployment rate also rises. There are other influencing factors also to keep in mind that could potentially also have an impact on the delinquency rates, and that's the credit union's underwriting practices and their assessment of a member's ability to repay, the loan terms and conditions and how those correlate to a borrower's capacity and the general economic conditions. Generally in a strong economic environment, borrowers may be able to manage higher payments better, but in weaker economies, even a modest increase in loan payments could potentially exacerbate financial conditions for members.
Okay, thank you.
That concludes my response.
Thank you. And how would raising the interest rate ceiling to 21% affect credit unions' members' ability to gain access to affordable credit? And I think your response kind of touched a little bit on this, and affect their mission to provide credit to those of modest means.
Certainly. So I'll address it from 2 points. Raising the ceiling could theoretically allow credit unions to enhance their ability to better risk price their loans and offer credit to a wider range of borrowers. However, raising the ceiling could potentially have an impact on credit affordability, as we discussed in the prior question, especially to those members with more modest means. It could increase borrowing costs for members, specifically to those that are already close to the current rate cap or those that have less favorable financial profiles. And that could lead to higher monthly payments, particularly in an inflationary environment where cost of living is already rising could make credit less affordable and potentially stretch the financial resources of lower income members or those who are already struggling. That concludes my response.
Thank you. Yeah, I think it's important to remember that, credit unions are not-for-profit organizations whose main mission is to provide credit and financial services to communities that need it the most. Instead of aiming to achieve a particular profit margin or satisfying shareholder interest, this mission is really core to what credit unions do, and that should be the most important consideration for credit unions. But I think at the same time, I think we understand, right, as we've discussed, the economic conditions at the one time the NCUA board has raised the interest rate ceiling were far higher. Inflation was far higher than it is even today, and there are much more positive signs today than there were back then. We're talking about a very different economic environment when the NCUA board raised the ceiling to 21%. So for these reasons, I support maintaining the interest rate loan ceiling at 18%. This rate provides more flexibility above the threshold that Congress established, and it also allows credit unions to grow while still being able to provide credit at a competitive rate compared to other financial institutions. So thank you, Chair Harper and Vice Chair Hopman. Thank you to the staff, and I'll turn it back over to you.
Thank you so much. Vice Chairman Hopman, is there a motion?
Yes, sir. I move that the board approve maintaining the current 18% maximum loan interest rate for federal credit unions effective September 11, 2024 through March 10, 2026, as detailed in the board action memorandum.
Is there a second?
Second.
There is a sufficient second. All those in favor say aye.
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 Aye. All those opposed say nay. The ayes have it, and let the record show that the motion passes 3-0.
This concludes this item. If your credit union could use assistance with your exam, reach out to Mark Treichel on LinkedIn or at marktreichel.com. This is Samantha Shares, and we thank you for listening.